Good afternoon, students. Welcome to School Subjects Accounting Module 2. Your presenter this afternoon is Soma Kambode. I'm going to take you through this module, so pay attention. This afternoon we are going to talk about bank reconciliation. First, I just want to simplify the term reconciliation. When we are talking about reconciliation, we are talking about when two parties agree. So in the case of accounting, which are those accounts that are not agreeing? We are talking about bank statement and the cash book. You know, the bank statement is a reflection of what has been happening in the bank. Whatever have been deposited, all the payments that have been made through the bank. And then at the end of the month, the bank give out the bank statement. And the cash book is all the cash transaction, the payment or the money that have been received in the course of the year. But a cash book is usually done in the business at home. Okay, use the word at home. Okay, now you will find a situation whereby these two books, they don't agree or they don't have the same balances. Why? And they differ. Now it's our job now as accountants to make them agree. And that process is what we call bank reconciliation. We want them to reconcile, to have the same balances, because we are going to look, where is it, what is it that we did maybe at home in the business, in our cash book, that is not reflecting on the bank statement. That's the result. We have different figures. Okay, bank reconciliation is the process of recording the bank balances as per cash book to the balances at the bank statement. Bank statement is a copy of the business bank transaction received from the bank every month, prepared by the bank for the business to verify if transaction and balances. Bank reconciliation statement, a statement used to reconcile the difference between the bank balances as per cash book to its bank as per bank statement, prepared by the business for the bank to make correction. I already explained to you why do we have to do the bank reconciliation. The reasons were simple. The need to compare our bank account with the bank statement. Due to the timing differences, omission errors can be made by the bank or the business itself. So the balances of the bank statement and the bank account in the cash book cannot agree. Purpose: to ensure that our records of bank receipt and payment as per cash book correspond to those of the bank as per bank statement, so that the two balances agree. Now we are going to look at the reasons to why you find a situation whereby the cash book at home or in the business have a different figure compared to the one of the bank statement. Why do you think they don't agree, or there is always a difference between these two? Why? One of the reasons could be outstanding deposit, uncreated deposit, bank arrangement. These are deposits paid into the bank as per cash book, but they were not credited by the bank. Sometimes in the morning, customer came to buy goods with cash, then you recorded that information in your cash book, okay? Then after, you went to the bank to deposit this money. In your cash book, this money is recorded, but in your bank statement, although you have deposited, this deposit the bank haven't deposited, it's not yet reflecting in your bank statement. It will wait until the next day. So for that specific moment in time, there will be a difference. Unpresented check. Unpresented check, outstanding check, these are checks paid by the business as per cash book, but that has not been presented. Sometimes a customer will come, she writes a check of 10,000 to pay off what they owe you. Okay, you record that in your cash book, but you are still sitting with that check for weeks or for days. In your bank statement, it's only will start reflecting if you take that check to cash it at the bank, then it will start reflecting. Otherwise, before it's you go to the bank, you have 10,000 paid in your cash book, but in your bank statement, it's not reflecting because you haven't presented it that side. Standing order. Sometimes there are standing instruction from the business to the bank to make regular fixed payment to specific person or organization. Let's say, for example, your business have an amount of money that it pays on a monthly basis, and you don't like to be going to the bank every time to deposit every time. So you make an arrangement with the bank so that they will be deducting that amount of money from your account, business account, straight to the supplier's account. So according to the bank, that money is there in the bank statement because it's happening in the bank. But you only have to wait until end of the month when you have to go print out the bank statement. Then you're going to transfer that information in your cash book because you are not paying cash. It's the standing orders that are being deducted from your bank account. Direct debits. These are payment made directly through the bank. Let's say, for example, some of your debtors prefer EFTing you, transferring money through your bank account without coming to your business to pay in cash. So you can only see proof of payment if you get the income statement and do the verification. Otherwise, in your cash book, you will not know who paid unless you get a printout of your bank statement. Then you know, oh, my customer paid. Then you are going to write it in your cash book. Before that, your cash book will still have a difference because debtors paid through the bank, but you don't have that information in your cash book in your business at the moment. Bank charges also. No, bank charges are penalties or payments that the bank charges or deduct or subtract from your bank account for you because you are using their services at the bank. So all these bank charges, the amount that they subtract from your business account, they will not reflect in your cash book, but they are there in your bank statement. Errors in the cash book, sometimes you as an individual, when you are your bookkeeper or let me say the accountant of the business, will be doing some errors. So at the end of the day, when these errors are made, then these errors are made in your cash book, they will not reflect on your bank statement. Dishonored check, these are checks that were written by the debtor, but later when you take it to cash it, it is rejected. Let's say maybe in the debtor's account there is nothing, so you have to come back with it. We have the credit transfer. Direct credit, these are money received from customer directly from the banking system. We have interest on current account. Let's say, for example, in your account there is enough money, so that's why sometimes your bank give you some interest. It's an income, so that will not reflect in your cash book. We have interest on overdraft account. Maybe you are charged when you are charged for doing overdraft. Then this money will also not reflect on your business account. Okay. This is a format of bank reconciliation. We have a debit and the credit side. The debit balance is bank statement. This balance you get it from your bank statement. You write it on the debit side. You record all the outstanding deposit on your credit side. If there is any rent received, you record it on the these are outstanding debt on the credit side again. Unpresented check, you record it on the debit side, and then later the correction credit balance as per cash book, the supplementary cash book that you do before you do the bank reconciliation from your cash book. Then that is the balance you put on the credit side. That's the format. Now we are going to talk about control accounts. What are control accounts? What is the use of control account? And what are the types of control accounts? Control account is an account in the general ledger which summarizes the transaction in debtors and creditors ledgers account. Two types of control account we have: debtors control accounts, the summary of all the credit customer transaction over a given period of time. Creditors control account, the summary of all the credit supplier transaction over a given period of time. Advantages of control accounts. They act as an independent check on the arithmetic accuracy of the totals of balances in the debtors and creditors ledger. They help provide total of debtors and creditors quickly when a trial balance is prepared. They help identify errors when there is a difference between the control accounts and the sum of individual ledgers. To act as an independent internal check on the work of the account clerk to detect errors and prevent fraud. The control account are prepared by a person, then the person who prepare the data and credit ledger who make fraud more difficult. Debtors ledger against debtors control account. Here we should know what to record in the debtors ledger and what to record in the debtors control account. This is the format of a data control account. And then I'm going to repeat again. Whatever the information that you are given, when you are dealing with debtors control account, what is a debtor? A debtor are people that owe us. And debtors are assets. And assets increases on the debit side and they decreases on the credit side. So this is the debtor. This is credit side, this is the debit side. This is the accounting rules. Okay, now, the information that you know, I'll just pick randomly any transaction from the slides, and then I'll show you how to record and where to record. Credit sales. What does it mean? It means your business sold goods on credit to customers or to debtors. Where are we going to record? We are going to record on the debit side. Why? Because debtors are increasing on the debit side. You see, when you sell more goods on credit to customers, then you have more debtors, and debtors are increasing on the debit side. Okay, another example. Cash received from debtors. What does it mean? Maybe this was 10,000 and later some debtors decided to pay off their debts. So our debtors are going to increase and therefore we are going to record on the on the credit side. So let's say they pay with cash of 5,000. Can you see? So now at the end of the day when we are going to cross off, we are going to say this is 10,000, this is 10,000 and this is going to be balance carried down 5,000. The difference between these two, because we sold goods on credit to our customers 10,000 and later that same customer pay off their debts, half of the debts, which makes it 500. So in the next month this customer is going to be owing us 5,000. So now next month when we are going to start, we are going to say debtors control account balance brought forward 5,000, and then we start with we continue with the month. You see, balance brought forward increases our debtors control account. Credit sales, dishonored check. When we are talking about dishonored check, these are checks that are rejected. Our debtors came to us with the intention of paying off their debts, but they were rejected because they didn't go through. So this is not this honor check will not decrease our debtors, but increase the debt is still there. So that's why cash refunds on the debit side and so on. Creditors control account. It's a summary of all credit supply transactions over a period of time. This is where we are recording all these ones. And then the example of a creditor's control account is there. It's a vice versa of the other one. Creditors is a liability. Liabilities are always increasing on the credit side. and decrease on the debit side. When we buy goods from our supplier on credit, we record this one, purchases 10,000, see, on the credit side. Okay, later when we decide we are going to pay off our some of our supplier, say cash, let's say for example we only pay off 3,000. See, our credits are increasing on the credit side and they decreases on the debit side. So at the end of the day, when we are going to see the balance, we say 10,000, 10,000 here. And then what is this, what is the difference between the two? This is going to be 7,000. This 7,000 we are going to start off with the next beginning of the next creditors next month, which we are going to say balance BD 7,000, and we continue. Okay, so that is the creditors control account. Now we are going to look at the trial balance. If you can remember very well, we spoke about we have a group of accounts. We know already where to record what and so on. A trial balance is a list of all accounts and their balances from the ledgers at a specific point in time. Purpose of a trial balance is to prove the equality of debit and credit from the ledgers, enhance providing the correctness of the double entry principle, to check the arithmetic accuracy of ledgers. If there are errors, the trial balance can be used to find them. Because if the trial balance that doesn't balance, it means there are errors. Then we are going to see what we are going to do. The trial balance, we have debit side. What is it that we are going to record on the debit side? We are talking about assets, expenses, and drawings. All those accounts, they are recorded on the debit side of a trial balance, because a trial balance have two columns, debit side and a credit side, and you should know which one to record on the debit side and which one to record on the credit side. So the one you record on the debit side is the assets, expenses, and drawings, while on the credit side you record liabilities, income, and capital. The moment you mess up, you don't know which one, you should always ask yourself. I'm going to say this for the last time because I see most students, they don't know what to do. If you know that you are dealing with an asset, dealing with an expenses, dealing with an drawings, then record on the debit side. If you know that you are dealing with credit, liability, income, and capital, record on the credit side. Okay? We are now going to talk about errors that do not affect the trial balance and do not involve in the suspend account. Okay? Errors that do not affect trial balance and do not involve suspend account. So errors that does not affect trial balance, there is no need for the creation of a suspend account. I'm going to explain the suspend account later. These errors are, or before we go to the errors, these are errors, even if they are made, your trial balance will still agree. Your trial balance will still have equal balances. They will still balance. These are errors. Number one, error of omission. When a transaction is not recorded at all, nothing. So there is no debit side that was recorded, there is no credit side that was recorded, so nothing. So the trial balance is still going to be having the same balances. Error of commission. A transaction is entered in the wrong account of the same class. Wrong account, the same class. Error of principal. A transaction is posted to the correct side of the wrong account. Example, an asset entered in an expense account. You see, assets are supposed to be recorded on the debit side, yes, but it's a wrong account. They put it under expenses, but it's still gonna balance because it's still on the debit side. Okay. Errors that do not affect the trial balance and do not involve, it's continuing. Error of original entry, where the double entry is correct but carried with the wrong figure. The initial transaction had an amount of 500, and then there you recorded 250 on both credit and debit side, you're still gonna balance, although there's an error. Complete reversal error. A transaction is entered on the wrong side of both accounts. The amount and the account are correct, but the account that should have been debited is credited, and vice versa. Let's say, for example, you bought goods on cash, or let's say you paid electricity cash. Electricity is an expense, supposed to be on the debit side, and cash is assets because it's decreasing because you made payment, supposed to be recorded on the credit side. So then you swap them. Expenses, water and electricity with the same amount, you record it on the credit side, and then cash on the debit side. It's still gonna agree because it's the same figure. Okay? Compensation error, where two errors of the same amount cancel out the effect of the other in the trial balance, does not affect the trial balance but involves suspect's account. These are types of errors with examples. Just have to take a look one by one, like I've already explained them to you. What is a suspense account? A suspense account is an account in the general ledger in which amounts are temporarily recorded. Two reasons why a suspense account is open. A bookkeeper is unsure where to post an item and enter it in the suspense account pending instruction. There is a difference in the trial balance, and the suspense account is open with the amount of the difference so that the trial balance agrees pending the discovery and correction of the error causing the difference. This is the only time an entry is made in the records without a corresponding entry elsewhere. Suspense account continue. A temporary account open where there is no immediate identification of the cause of the error in the trial balance. That is a suspense account. Now we are going to look at the types of receipt and expenditure in the business. We have 4. What are capital expenditure? Capital expenditure, these are all expenses incurred to buy or add value to fixed asset. Money used to buy or to acquire fixed asset, that is capital expenditure. Or when you are using money to make renovation of the building, or adding value to a vehicle or equipment or machinery in a business, that is capital expenditure. Revenue expenditure, or expenses incurred to cover day-to-day business operation. Let's say, for example, you need to pay for water and electricity. You have to pay for advertising. You have to pay for telephone bills. Because you are paying these expenses because they are needed in your daily dealings in your business, that is revenue expenditure. Capital receipt, or receipt from sales of fixed asset. If you dispose of your fixed asset, say for example you are selling off your vehicle, you're selling off your machinery, that becomes capital receipt. Revenue receipt, or receipt income from the sale of goods rendered or service in normal activity trading. I'm going to introduce you to a format of a trading account. That's an example of a trading account. We have opening stock. This is a horizontal format. You choose whichever method you want to use, either vertical, the straightforward one, or the T format, or sometimes referred to as horizontal format. That is a format. Opening stock plus purchases plus carriage inward minus sales minus closing inventory, then you get your gross profit. That's the format. Or when you want to determine the gross profit of the business using a vertical format, you can start sales minus sales return less cost of sale. How do we get cost of sales? Is taking opening stock plus purchases plus carried inward on purchases. Then we get our cost of sales in brackets, because we should, anything that you are going to subtract from any amount in accounting, put brackets so that you know that you are subtracting it from somewhere. Then you take your sales minus cost of sales, then you get your gross profit. This is now the profit and loss account. After you know your gross profit, now you continue either with the horizontal format or with the vertical formats. It's up to you. Just know that all the expenses, you see, we are still applying the accounting rules. You see, on our debit side here, we are having all the expenses listed down. And on our credit side here, we have all our income listed there, because income are always increasing on the credit side. You see? So now, wages, bad debts, depreciation, loss of disposal on the credit side, on the debit side, while rent receive, gross profit, bank debt recover, discount receive on the credit side. Then you see the difference to see if you have made a loss or a profit. This is the vertical format. After your gross income, less expenses, you add income. If there's income, that is the format. And later you get your net profit. You decide which format are you going to use, which one is more simple to use. As long as you know your groups of account. Okay? Now we are going to talk about departmental account. This one I just want to simplify it first before we go to the slides. Departmental account. Okay, there are businesses which have more than one department. So now at the end of the day, the business owner want to know which department is more profitable, which department is not profitable, and which department is not doing so well. So, in short, departmental account is just a combination of two departments in one income statement or one trading account. But it do have two departments just to make comparison which one is doing better and which one is not doing so well. Reason to know the result of each department, it let us know the expenses and income of each department clearly at one place. It helps us to compare the result of each department, help us to formulate policies in order to develop the business on proper lines. It decide whether to drop or start a new department. It helps us to reward the department manager. Okay, this is an example of the balance extracted from the books of Fintech Trading as 31st March 2015. We have sales, department A, shoes, department has 60, clothing department has 42, stock, purchases, carriage inward, stock. Now, instead of doing it only for one department, now you are going to do it for two departments. It's going to be very, very simple because you just have to write sales department, shoes department. Let me give you an example how it's done. Let's say, for example, we are going to do the trading account. Trading account for who? Fine tech. Okay, now we are going to use the vertical format. Okay, we have shoe, we have clothing. Okay. Now let's start sales. How much is the sale for shoes? 60,000. For clothing, 42,000. Okay? Cost of sales. Okay? We start with stock. The stock opening one. Stock here we had how much? I was supposed to have another line. Of course, this one is going to confuse me. Okay. Okay. How much is the stock? 10,000. For the other person, shoe, clothes. Let me just write another one which is clean. Okay. Trading account. Okay. We have shoe. We have clothes. Okay. Yeah. Now it's okay. Good. You can see. Alright. Sales. How much? 60. We have 42. Okay. Cost of sales. We don't have the amount now. Okay, we have to start with stock. Opening stock. Opening stock, we have 10,000 here. We have 20,000 here. We have add purchases. We are adding. How much is the purchases? 25. We have 40. Sorry, I don't have a calculator. We have carriage inward. Inwards. Here we have 180. Here we have 1,200. And then less stock. The last one. We have 15,000 blankets. We have 10,000 blankets. Okay, this one added together minus this will give us the cost of sales. I don't have a calculator, so I'm just going to go to the slides and see how much. Here we have 21,800 blankets again. Here we have 51,200 blankets. So now we want to know our gross profit. Then our gross profit will be 60,000 minus 21,800. It gives us 38,200. Here we have 27,000. Both are, do we have a negative? No, this is not 27. This is 11,200. Sorry. It's a gross loss because this one is more than our cost of sales is more than our sales. So this is a gross loss. This is why I put it in brackets again, because I'm going to continue with the expenses. That's how it's done. Okay, that is how it's done. Okay, we go to the expenses side. The expenses: rent paid and water and electricity according to floor space each department. We will be given floor space. Should department occupy half this floors occupy the clothing? Advertising and carriage outward according to sales. And you know how to calculate them. Okay, that one is done. So expenses is there. Rent paid, each department has its own, then you know. So at the end of the day now, you are now going to make judgment which department is doing so well. You see, shoe got profit of 22,760 and clothing a negative of 23,760. So the reason why we do this is because we want to make comparison to see which department is doing so well and which one is doing so bad. But the reason why I think this department, clothing, had a gross loss is because it has too much purchases and the cost of sale went up. That's the and resulted in it having too much loss. Income statement. Instead of preparing a trading and profit and loss account vertical format, we can prepare an income statement. It is a financial statement, not an account, prepared to measure the firm's financial performance over a given period of time. The income statement report to the net on the net profit or loss for the period by matching period expenses with the income they generated in the same period. That is the matching principle. The income statement shows the total income minus total expenses for a given financial period. It shows how the business perform over a period of time. Net profit if total income exceed total expenses. Net loss if total expense exceed total income. The income and expenses amounts are taken directly from the trial balance if no adjustments are given. The balance sheet. Assets equal to owner's equity plus liabilities. The account in the balance sheet are divided into two categories. We have capital employed, show where the funds came from, usually obtained from owner's equity and liabilities. Employment of capital show what was done with the fund, hence used to finance assets. Compare total assets, fixed asset plus investment plus net current asset, working capital. Compare total liability, long-term liability. Total owner's equity or opening capital plus net profit or minus the net drawings for the period. This is an example of a trial balance. And it's from this trial balance that we are going to do our income statement. I'm just going to show you quickly on how to do the income statement as well as the balance sheet from the information that are given in this trial balance. Can you see when I was talking about a trial balance must supposed to have equal figures both on the debit and the credit side. We have capital there. You see, when I was talking about the classification of assets, of accounts in the trial balance, which one are to be recorded on which side, and so can you look at the example of a trial balance there? You see, or if you can identify all the capital, all the liabilities, and the income, you can see that both are recorded on the credit side. While drawings, expenses, and assets, they are all on the debit side. Just take a look quickly and see. Capital is on the credit side. This one, provision of depreciation of equipment, creditors we have here. You can already see, okay? The income statement. Sales. Let me go back to my, how much is a sale? 17,750. This is what you get here. Minus 800. Where that 800 came from? 800 is a sales return. Because although you have sold so many goods to customers, there were some that were returned to you because there were 40. You need to subtract it from the sales. Okay. Moving on. Opening stock. Where do you get that 8,700? It's from this income stock. 8,700. See, all the information are there. Purchases, minus purchases, returns, carriages, what is there. Income, we have those income, interest on fixed deposit. Let me see if I can get interest on fixed deposit. Of how much? Here I'm having 5,500. Would I get it? Interest on fixed deposit. Yes, on the credit side. Okay. You see? So the net, there's a net loss. So there is a net loss of how much? The screen is not yet visible on the other side. Okay. All right. Then after that, the net profit or loss that you still need to use it in the balance sheet. How do we do the balance sheet? You start with capital employed. I was already explaining to you what is capital employed. Capital employed show where the fund came from. The sources of fund. Let's see the sources of fund. We have capital, we have net loss, we have drawing. This net loss and drawings are to be subtracted because they decreases our owner's equity. Okay. How much was our capital stated in the trial balance? 96,500 minus net loss. You get that amount minus drawings, then we get 86,020 Namibian dollars. Then you continue. Non-current liability, we have mortgage. Non-current liability, where is it? Oh, the one for 30,000. You see, that is a liability. We record it there. Okay. Then the total capital employed, we have 100,000. 16,020 Namibian dollars. We come to improvement of capital, where we are going to record, what did I say about capital? Improvement of capital shows what was done with the fund. This fund that was generated in the business, what was it used to for? And it was used for acquiring assets. Can you see? Non-current assets. We have premises, we have equipment, and then the cost, the figures are there, and the depreciation subtracted, then we get the book value. And later we came down to 55,000. And then we added investment. The investment was given here. Where is the investment of 55,000 coming from? The investment of fixed deposit FNB, Namibia. So then we have an investment. Then we have non-current assets, where we are talking about bank, stock, debtors. They are there. The total made it to 10,120. We have debtor. We have current liabilities. Creditors only 1,800, which should be subtracted from the current assets to get the working capital. Okay. Now we are moving on to partnership accounts. Partnership accounts, profit and loss account, capital account, loans account. Partnership account, this is account when two or more partners come together to make business. They share profit, they share idea, they contribute more capital in the business. That is the advantage of partnership. So at the end of the day, they come up with a partnership account. Okay? I just want to... Okay, accounting entries for partnership. Interest on loan from partners. Interest on loan from partners. When a partner, one of the partner, borrowed money from a business, that is an income to the business. Why? Because they will be charged by the business the interest on the loan they have borrowed from that business. So therefore, how are we going to record this one? We say debit profit and loss account and credit partners current account. Why credit it is because it decreases the income of the partner, because when your partner borrow money from a business, they have to pay it back in future with interest, and that is an expense to partners. Interest on loan to partner. Oh, no, I'm sorry. This is what I'll explain first. To a partner. But from a partner is when, number one, interest on loan from a partner. This is when the business is borrowing from partners. And then when business borrow from partners, this is partner's current account is debited. Is debited, and profit and loss is credited. Partners drawing, when partners are withdrawing money for their own personal use, debit partners current account and credit partners drawing. Interest on drawing, this is a penalty given to partners for not to stop drawing from personal use. Then interest on drawing is stated as debit partners current account and credit profit and loss account. This is a format, the T format of a profit and loss appropriation. You can already see OMC and IMS. The profit and loss appropriation account for the year ended. Partner salary. Partners are generating a salary, right? That is an income to them. That's why it's on the debit side. Interest on capital. The partners are getting money, interest based on what they have invested in the company. Is income for them. That's why it's recorded on the debit side. Profit and loss, interest on drawing is a penalty payments done by partners to the business, recorded on the debits on the credit side. So you share. This is the vehicle format. Yeah. That's how it's done. Sales, cost of sale, okay, gross profit. Then add interest on drawings, less partner salaries, share profit. So you can choose whatever format that you want to use. Okay, so students, we are going to conclude off with the goodwill. When we are admitting a new partner, the next person that is coming in the partnership, you know what value of the business am I getting into. So a goodwill is a tangible asset value according to the advantage, benefit, or reputation a business has occurred. Some reason for goodwill: good reputation, established business connection and customer base, reliable workforce or location. This benefit will result in more future profit, and these original partners need to be compensated by the new partner for their share of goodwill. Students, we have come to the end of our presentation, or I'm urging you just to work very, very hard, go through the slides, pause where you don't understand and read carefully, use all the study material given to you, or I can say good luck. Accounting is very, very simple. Concentrate on the accounting rules and master them and understand them. You don't need to memorize anything, you just need to understand. Use your logic, think through, and all the best in your studies. Thank you very much.